Traders are sifting through Jay Powell's remarks after the U.S. Fed signaled that it is moving close to cutting rates from a two-decade high. Powell said in his press conference that the economy is moving closer to the point at which it will be appropriate to cut borrowing costs. But, quote, we're not quite at that point yet. Let's get more from Jason Schenker, president of Prestige Economics. Jason, always great to see you. What jumped out for you from Powell's remarks today, please?
Yeah, thanks so much for having me on today, Andy. I think the most important thing is this concept of a totality of data. That's what the Fed is going to be looking at going towards September. They're not there yet. They're almost there, ready to cut rates, but they are still data dependent. So it's really going to depend on what happens going forward with the especially inflation data. I think the other thing that's really important, we saw in the Fed statement, we heard it in Fed Chair Powell's remarks, an acknowledgement that inflation isn't the only risk right now. There's now two-sided risk. There's also risks to the labor market. So the Fed's going to be watching both of those things very closely, the labor market and inflation.
Once they do cut interest rates, is it a given that gold will do better, or do you think it's in the gold price already?
Well, I think there's a couple pieces here. As you see a cut in interest rates, typically what you'd also expect is the dollar to weaken. Because gold is priced in dollars, we'd expect there could be some further uplift there. In general, that's true for most commodities because many of them are dollar denominated. A slightly weaker dollar likely to provide some uplift, especially for industrial commodities where lower interest rates could also support global manufacturing, and a weaker dollar would also likely be very helpful, especially for emerging markets that have dollar-denominated debt. That strong greenback has been a lot of pressure for them.
That's an interesting point. So a lower dollar, is it possible to generalize? Is it good for commodity producers? I guess it's not great. I mean, I'm thinking about a lower U.S. dollar. I'm thinking about a Canadian oil producer. They love having a strong U.S. dollar.
Yeah, so it depends if you're a buyer or a seller. Yeah. If you're producing commodities, selling them into the global market, then a strong dollar that you're repatriating back to your country, that's going to be better for your profits. But when we're thinking about global growth and global manufacturing and global economic activity, for most countries around the world, that weaker dollar is likely to be a bit more helpful because that will allow them, especially in emerging markets where you have dollar-denominated debt at much higher interest rates, that 1-2 combo of a weaker dollar and lower interest rates can provide an uplift to growth, and that drives up commodities demand.
I want to just make sure I have it right here. Now, you talked about the Fed's dual mandate, and they did refer to that. I think they referred to the danger, the risk of weakening the job market too much. But you reckon America is still pretty close to full employment?
Yeah, the labor market is still in pretty good shape. You know, the unemployment rate, even though it's gone up recently, it's at 4.1%. That is still a very, very low unemployment rate. We look at the job openings, the JOLTS data out just this week show there were almost 8.2 million open jobs. So there is still a lot of strength in the labor market. Jobless claims, although they've gone up, are still very, very low. So there's a lot of good stuff going on in the labor market, but people will be watching very closely to see what happens in the report out this Friday, as well as in the report that we see out in the beginning of September. Those two jobs reports, the July report out this Friday and the August report out in early September, are two of the most important data points that the Fed will get before its September decision.
And what about the oil price? Is there any implication in the Fed rate cut for the oil price? I mean, that's a hard one to untangle, isn't it?
Well, I think the lower interest rates that's supportive of growth, both in the United States and globally, should be a bit supportive for prices, especially because if we see a weaker dollar and crude oil is dollar denominated, we'd expect that price to go up in dollar terms as well. So there are a couple of positive things if you're an oil producer. Again, you're looking at potentially seeing the dollar price rise, and you're looking at seeing global aggregate demand for oil rise. And strong global growth is good for a lot of markets. The next thing to really watch for will be to see what Fed Chair Powell says at Jackson Hole later in August, what other Fed speak we hear. If the Fed really is leaning towards this cut in September, we need to hear probably more Fed speak, preparing markets for that, even though it is widely priced in ahead of that decision, because they still are saying they're data dependent and there are risks.